The good news is last year was a very, very good year for the stock market. And it's interesting that there's a lot of very unique things that happen, meaning how the stock market behaved. First off, and you'll see this a lot of times in some of the things I present, I really like to go get the data. 90 years since the S&P closed every single month in the green, or made money every single month. It's very rare that that's ever happened. There's only actually one other time that happened, and it was way beyond any of us were alive. So it's a pretty unique time. And hopefully throughout these slides, you can kind of see the justification on why this is happening. And so you can get a better feel about what should potentially happen this year. Some of the key things that were really interesting to me this week is that typically earning estimates kind of fluctuate because, throughout the year, there's, different fiscal years that end. So companies don't make money every single quarter. It's just some of them make all their money in one quarter and then report it for the whole year. But it's very rare that every single quarter it's expected for the profits to be increasing. So the industry, for a first time in a very long time, revised their earnings estimates this year, way higher than they had last year. So that's typically a good sign. Although that is estimates and not actual real earnings. So this was something that I actually had to dig up when it was getting close to the record, but it was funny. We went back and pulled the data from a couple reports, and we went 381 days last year. Actually, it's probably 385 now, without the market at least having a little 5% dip. It just went straight up like a smooth sailing train. And I just wanted to show this in the first few slides because it's important to understand this is very abnormal. It's nice, feels amazing. You log into your account and you go, oh wow, I made money today. Oh wow, I made money tomorrow. Every week, every single week, it's going up. But there's only been 4 times in history, the data we have only goes back to basically the 20s, where it's been this calm and there's been that much conviction in the stock market. Lucky for us, we've been invested throughout this whole time and gotten every part of this. This is just sort of another graph to show that the drawdown last year was only 3%. That's minuscule, tiny, very, very abnormal. To put this into context, we have to try to understand, well, what is normal? What's a normal fluctuation in our stock portion of our accounts? If you go back, look at the same data, a normal drawdown is around 15%. And that might seem like a lot, but that's typically what you can expect when you're invested in stocks. Now, these years you can see were pretty deep drawdowns, but what's also interesting, like say take this year, at some point it lost 22%, but then it closed up 26%. So it's kind of wild. The stock market has a big variance. And despite how wild it can be, on average, it returns about 10% annually. And what's so interesting about that number is that one, you can see there's basically no year where it actually returns 10%. It's always double digit, 30%, 20% returns, or we get small flat years or some minor loss years. So that average number comes from a much bigger variance. Now that's the up and down measurement of the market. Another thing that we track pretty closely is the duration. So like how long it's been doing this. Last year we pointed out we were neck and neck for the longest bull market in the history of the stock market. Right now we're in yellow. So right now we're chasing down the record. The green I think was 2000 internet bubble. So you can see, in terms of how long can this go based upon its own behavior, we still got a good runway left. Still got about 2 years before we are in the longest bull market ever. So that's kind of an interesting context to take away. And if you guys have any questions while I'm going through this, please stop me. I'm just going to try to keep hammering through. So I love to pull these statistics because it really gives us a granular understanding of how to understand this process of being invested. What's normal to happen is, just based upon the statistics of the stock market, it's very normal to have at least 5% dips during a year. And we actually try to take advantage of that. Say we get a new client and we have been going a while without a dip. We'll try to wait and feel it out. If there's some news event, if there's some natural seasonal thing that will push the market down, we try to buy when things are on sale pretty much. Last year was one of those years where we got to about June and I was like, I don't think the dip's coming, John. I think it's just going to keep hammering higher, just because the data was so good. That, earnings have not been this good, arguably, in my lifetime. They're just tremendously strong right now. We could also expect, larger magnitude drawdowns. Every 2 years, essentially a bear market typically can happen every 5 years. Again, these are no hard and fast rules. These are just, we pull the data and we run the statistics on it. Despite all this, volatility, what's really interesting to me, we get that 10% number. 10% annually essentially doubles your account every 7 years, 7.5 years. So that's something to keep in mind. Is the long run is somewhere around that length of time, and it's the ability to understand what is normal and what is abnormal that can kind of keep us on track, keep us from acting in emotional ways. The next thing I wanted to talk about was the economy. There's so much information being floated around about the economy right now. It's really difficult for me to even understand what they're trying to tell people in the media. So what I've done is I've just taken a very simple model, simple way to look at the economy. And what we do is we pull a tremendous amount of data from an array of sources. We do this all in-house. And we basically check off the boxes, so to speak. And right now, what's interesting is if you look at things that typically happen during this phase of the economic cycle, like an expansion period or a boom period, a lot of these things are happening right now. You get double-digit gains in stocks. GDP is 3%. Inflation is starting to pick up a bit, which is causing interest rates to rise. So we're a lot of evidence that we're in a nice boom period. But what's also interesting is if we kind of look backwards, there's still a lot of evidence that we have this, generalized recovery going on. So, there's credit expansion and there's still federal stimulus for some reason. So it's important for us to put this in context, because if we start to see these other symptoms, we're going to try to be very vocal with that with you, and so you can understand where we're getting towards the end of that cycle. If we see profits start to slow down, if the yield curve inverts, which I'll explain in a bit, if the Fed hikes interest rates too fast, that could definitely choke off the banking system. So these are kind of things that me and John watch on a day-to-day basis. We have a bunch of computer programs that do this for us, so we're sort of just analyzing it from day to day. I don't expect you to read this, but what I do often is we have our own models in-house, but I'll also peek at what they're doing in these big investment firms. Goldman Sachs arguably has the highest paid, smartest people on the street working for them. And they have a model that's kind of similar to what we have. It puts a probability on recession happening in 1 quarter, 4 quarters out, 8 quarters out, and 12 quarters out. So they say, just that data we saw in this slide, given how the data is looking, how probable is a recession to happen, in the future? And the average numbers here in gray. But what's really quite fascinating right now is not just in the United States, but almost every major developed country has very low probability of having a recession right now. And that's important because we all trade together, we all kind of affect each other. So if we're all booming together, it's generally a very, very good thing. For example, in their model, the United States has less than a 5% chance of going into a recession for essentially a year. So that gives us some pretty good confidence. I mean, they're giving this report out to major institutions that buy, Goldman Sachs investment models, and they're making decisions off of this. So it's sort of like you want to know what your opponent's game book is, so to speak, so we can kind of analyze our own models in context. I don't expect you to see this, but essentially the reason why we're so, I would say, obsessed with knowing when the next recession is going to happen is we know this very simple statistic. Since World War II, there have been 10 bear markets where stocks go down at least 25%, and only 2 of those times have been outside of a recessionary period. Mainly they were crashes. They were just, unforeseen events that took stocks down that had no association to the economy. So this is something that we talk about in previous presentations where the economy is very related to the stock market. I mean, if not, you can argue they're the same thing. So that's why we focus a lot on this, looking at the state of the economy. For some of you who are not our clients, we operate very different than your average investment manager. We don't believe in buy and hold. We don't believe in having to be invested forever. We actually have strategies that will keep us in cash for quite a long time, sometimes up to a year or even longer. And that's just something we want to build in our repertoire so that if we get to that point, we know it's totally okay. It's totally okay to sit out and just wait and be patient. The good news is some of the very sensitive data points in our models are just going straight up. Retail sales is like the canary in the coal mine. How many of you bought something on Amazon this Christmas? 11 billion packages got shipped this Christmas season. They just killed it. The retail landscape is changing right before your eyes, and that, historically is the most sensitive measure because that's average Joe's pocketbook. If something's going wrong and he's not employed, you're going to see it in this data. This is also including restaurant sales, so going out to eat, things that are very sensitive to the economy. And you can see we're just trucking along here, made an all-time high. That is a very good sign. One of the first pieces of data that will start to kind of fizzle out and go down in precedent to a bear market is definitely the retail sales number. Earnings, we talk about this so much, it's like beating a dead horse, but essentially this is the main component that drives stock prices higher. And we have a lot of internal research, and there's a lot out there that essentially proves this point. And what's interesting is, there's no real way to know what the 2018 earnings are. They have always estimates, but it's the first time I remember in maybe 10 years that they're revising these up like quite drastically. Like they definitely underestimated how much this tax package is going to affect a lot of these companies, and so they now have to re-up their models. So this is something that I've been seeing lately, and it sort of gets to me. We talked about it in a previous one I called debunking, but how many of you have heard we're in a bubble or read we're in a bubble? It's like a car accident. They want you to look and to feel scared. And so I just wanted to kind of show what is the difference between a bubble and then today. Well, in the internet bubble, all these companies had no earnings. They had no profits. They made nothing tangible. And the stocks kept going up and up and up, and they didn't make a dime more profit. That's what causes it to pop, right? In the housing market, that was sort of what caused this to go down. It wasn't necessarily the stocks earnings. But right now, what you can see is we're getting upward movement in stock prices and upward movement in profits. That should make you feel really good because those need to go hand in hand for it to sustain. So I'm going to show some more slides down the road about our view of what a bubble is and if we're in a bubble. But I just want you to see tangibly that what makes stock prices go higher is happening right now. This is a little bit hard to see, but we don't just invest in stocks. We have blended models, so you usually 60% stocks and 40% bonds in your portfolios. And you're going to hear, I think, in the media about rising interest rates. And so they're going to make it seem like it's a bad thing, but do you guys remember getting at least 2% in a savings account? wasn't too long ago. It's almost back to that point. The 2-year Treasury note is, I think, about 2% now. So in my view, in my humble view, I think interest rates are just getting back to normal, whereas the language around it right now is it's rising interest rates. I mean, that's when you get 10%. That's when it gets way out of hand. So the other cool thing about rising interest rates is that typically that's when stocks do even better than normal. So you get that 10% number, you do a couple points more during rising interest rates. So that's definitely happening as well. And I don't want you guys to feel scared about that. I actually think that's a really good thing that we're getting back to a normal state of interest rates. I'm going to pause there for a second because what was the last time? We talked about this maybe a year ago about the tax repatriation. Remember that? And it was sort of cloudy until recently when we actually got to see the tangible effect of that. But one thing to point out is this could be really good for our investment strategy. And one of the reasons that is because when these big companies suddenly are 20% richer because their taxes got cut, one of the first things they do with that extra money is they buy back their own shares. They want to create value for their shareholders. And this study was kind of interesting because it showed that not every sector of the economy is going to have that same effect. For example, the utility companies, they're almost going to have zero benefit from that. Whereas cyclicals like discretionaries, in our portfolio, that's like Home Depot, Thor Enterprises. We used to own Ulta Beauty very recently. Kind of your cyclical stocks, that could have a massive impact. So the reason that's important is because we don't buy every single stock in the stock market. We really focus on just profitable companies, and we hold a concentrated portfolio of those. And seeing this gives us a lot of a positive feeling about this year because we hold a tremendous amount of healthcare and a couple financial companies that could see a big benefit. The second thing about taxes is, they always try to put spin out there on it. And I just instantly say, okay, let's just go pull the data. Let's look at it from an objective point of view and see what could happen. Well, there's only been 4 times that I found where the tax changes in the American history have been, roughly the same. And I pulled all those times when it started, and I basically said, what happened to the stock market? And so not too many people realize this, but they cut taxes before the Roaring 20s. Huge bull market there. In the 60s, you had 85% gain in 6 years. And in the most recent, probably the most equivalent time that we are to today, this 80s, the Bush Senior cuts, we got 250% gain in 5 years. So underestimating the effect of how taxes are going to affect our investments is going to be a big mistake. It could be hugely beneficial. Apart from that, as an economist, I always sort of get a funny feeling when people try to discredit. They call it trickle-down economics, but it's really, how does when the large corporations benefit the average Joe? And this year has just been unbelievable to me. For example, Fiat Chrysler is going to invest $1 billion to modernize a Michigan plant, and they're going to give $2,000 bonuses to 60,000 of its hourly worked and salaried employees. That's a big stimulus for that area. I mean, that's a real benefit for those people in that area. Other companies, you're starting to see them every week start to announce this. AT&T, $1,000 for 200,000 employees. United Airlines, $1,000 for 130,000 employees. Bank of America, same thing. Apple, has the biggest cash pile of them all, $350 billion, more than the country of Germany. They have committed to creating 20,000 new jobs and investing all that money back in the United States. So that's what's really driving it right now. I think there's some of that animal spirits pushing us here in the first part of the year because a lot of these big management companies know that it's inevitable. It's inevitable for this to start to take effect in the economy. And what's also really fun is I never have to guess anymore on where the money goes when it starts to move in the stock market. I just have to find it. It's just somewhere in our data. We had the biggest record inflow into stocks last quarter. That's what kind of helped us go higher, right? So you got to remember, these companies like CalPERS, billions and billions of dollars, it's like a massive bureaucracy. They can't just say, oh, I feel like we need to own more stocks. They have to like vote on it, send it to some budget committee. You know, by the time it gets to where they're actually going to pull the trigger, you know, they're definitely late to the game, but they're going in a big way. And how they operate is they don't just pull their money out of stocks after they've decided to do such a big investment. Like they can't like put it all into stocks and then the next year say, oh, we don't want it there. Like they're committed. They're there. And so how do they get that money? Well, they have to pull it out of somewhere. It comes out of the bond market. So you notice John has been talking to you in meetings about potentially looking at, you know, a different model, maybe moving from Model 3 to Model 4, a little bit more stock. And this is really why we've kind of been talking about that, because we don't want to own too many bonds right now. It's not terrible to own bonds, but we would rather own the stuff that's going to generate growth and then reevaluate later. I didn't want to show this slide, but essentially this is cash. So what are they investing in? This is also kind of cool. We can see what they actually put the money in. And what's sometimes more important than what they invest in is what they don't invest in. But right now you can see they're heavily invested in healthcare, technology, industrials, financials. This is things that we've been talking about all last year. They're going to be, you know, big, good places to invest. But what happens in these really large funds is they can't ever go to cash like we can. They can't ever sit out and just wait out the storm. They actually have to stay invested in their bylaws or their prospectus. They have to be there. But what they'll do is they'll overweight these safety areas. They'll kind of put a ton of money in utilities, real estate, telecom. And so right now, there's not a lot of that behavior going on. So it just, again, we're looking at the other side, the other opponent's playbook, so to speak. And if they're not taking a very safe position, we can feel pretty confident that this next couple years, maybe 2 years, will be a pretty good growth period. Before we talk about our performance, I always like to pull random benchmarks other than just, you know, the S&P to kind of see how we did last year. This was kind of fun. I found this a couple weeks ago. This was every major financial magazine, like the big ones. There's probably newsletters that I just don't know about. But if you would have bought their top stocks for 2017, Motley Fool lost money, Forbes only made like 6%, some of these kind of, you know, 12, which is not bad, but only one beat the S&P. And so you got to remember, there's a lot of people that make their investment decisions off of these magazines, and, you know, they're not going to be getting the gains they could get because, you know, they're not really investment advisors. They're selling newspapers. And I just thought this was fun to kind of build our mental benchmark with. We are considered an active manager, so we're not passive. We don't just like invest and blindly hope that the world is going to be okay. We are in and out, we're active. And so this year, active managers as a whole did a little bit better than last year. Only 48% of them beat the benchmark, which is, you know, pretty respectable for how their track record's been lately. It's been really terrible. And so, you know, it's hard to put us into a box because we don't have any single category that we're beholden to. We can go anywhere we want, essentially. We don't need to be growth or value. So this is just another way to measure how we did versus other peers of ours. And last year, I will say we were up, I think 26% at one moment, and then December it kind of got wonky. I don't know if you guys are watching all that close, but we ended up, you know, doing exactly what the model is pretty much designed to do, 3% over net of fees, and we feel pretty good about that. Again, remember, we take the same amount of risk as the market. You know, I saw the other day where it showed this hedge fund made 50% 2018. You know how many stocks they owned? 10. I mean, that's That's way too risky. That's like literally owning lotto tickets. It's too much risk. Addition to this, we've jumped out of the gate. It's actually a little bit higher than this after today's gains, but we jumped out of the gate this year with already some stellar returns. And again, the reason we can get this excess performance is we don't own crappy companies that don't make money. We focus on profits. So as we're going higher, those companies just get a little bit more traction to the upside. So we'll be updating this not every time, but essentially maybe in the summertime or closer to third quarter, we'll take a peek again at our performance and see how we fare for the year ahead. That being said, having had 2 pretty darn good years in the strategy, I just want to make sure that we also take a step back and realize in order to get a different outcome than just the S&P's return, we're doing something very different. We're not owning everything, and we're using cash as a big component. So when you do that, you just open yourself up to different outcomes, sometimes good, sometimes bad. One of the things I just want to make sure you guys understand is statistically, and this is by design, or this is what happens in this type of model, is that basically 1 out of 3 stocks that we buy just won't pan out. It won't perform as well. It'll probably get shaken out on a stop loss. But it's not like we're going to be able to pick every single time a winner. And so that's going to be that trading that happens during the year. Is the model is going to always be trying to get rid of those ones and try to find ones that are a little bit better. Also, just by the nature of what we do, it's very possible that at least 1 out of 3 years we will not beat the S&P 500, and that's totally normal and acceptable. So I just wanted to kind of emphasize that as we go forward, into time, so that we're not blindsided by some of those things as they happen. Bubble talk. Oh my gosh. I think it'll get worse and worse throughout the year if it keeps going higher. But what I really wanted to myth bust this. It's like one of my favorite things to do is like pull the data and say, okay, let's stamp this one out. Let's make sure that we can put this one to bed. But I found a report that was pretty cool. It basically said, okay, given where the stock market's today, what would it have to do for it to be a bubble by whatever terms they were using? And their conclusion was it would have to go up essentially 1,000 points from where we are today, and that's about 60%. So I think that'd be actually pretty good for us. We'd get a lot of those gains. And it also provided me and John some context, right? So if we do start to melt up and we do start to feel this bubble potential behavior, a couple things are going to happen. We have profit targets on every stock that we buy. It's not just hold forever. So if we go up 60%, I guarantee a lot of those positions we have will start to sell because we're going to get to a profit point. And what also happens is if everything starts to move up together in bubble fashion, our shopping list just goes, we have nothing else to buy. So you'll see in your account, 1 month we might have 10% cash, we might have 30% cash. Like if we get more cash and you notice that could be sort of a sign that we're doing this. But trust me, it has to go vertical for this to come to fruition like that. For example, someone showed me an article. They're like, it's going to be 1987. It's going to have a huge crash. I put this year's stock market in blue, or this last couple years, and then the 1987 stock market in yellow. It's just, you can't compare. It's not apples to apples. It's nowhere close. It would have to go up essentially to be the same situation from 2,500, 2,600 essentially to almost 5,000. We'd have to, all our accounts would double, go up 100%. So in some ways, I hope that does happen. That would be very nice for all of us here. But it's just really unlikely. I'm a statistics guy, and it's just very unlikely. So this is kind of what me and John have been focusing on, trying to build context around. What could derail this? It's not all just rainbows and roses right now. Interest rates are really the biggest bogey on the table right now. Not a lot of people have seen this. For those of you who have, this is sort of a refresher. But the last 5 major recessions have all had what's called an inverted yield curve. And really what that means is, for some reason, the bond market reacts in a way where the 2-year US Treasury bond becomes essentially the same price as the 10-year Treasury bond. You go, how is that possible? Why would I give you money for 10 years for the same rate as 2 years? That just makes no sense. Well, that just happens when the market goes into safety mode. And what's interesting is it essentially has preceded a recession, and that's why we really focus on this stuff, by about a year. So we're here now. It's not anywhere close to that yet. You'll probably hear it more in the media when we get closer. But if that starts to happen, no doubt we will be moving into cash position. And so as John always says, it's better to be early than to be late with these things. And so if in this kind of situation, there could be a potential where we're sitting out on the sidelines, you come in for your meeting, you go, what am I paying you guys for? You're sitting in cash. And we're going to show you, like, this is the reasons, these models operate to save us from ourselves, that we're going to be, in a safe position. So with that, I'm just going to wrap it up here with a couple things about this year that I think are cool topics to keep in mind when you're watching the news or reading the newspaper. Hopefully some of these things are more positive than negative. But no doubt the political circus will ramble on, and it will make it very difficult to really understand what's going on, concretely. But remember, repatriation of this cash is a major component that's going to drive a lot of stocks. Tariffs. Who saw the solar tariff that you saw? So, not a lot of people picked up on this, but that's a big move. I mean, you can argue tariffs both ways till you're blue in the face, but the truth is the height of the steel industry in America, we had the most tariffs. So, for some industries it might be good, for some industries it might be disruptive, but if he gets slap happy with putting tariffs on stuff, I mean, it could definitely help certain industries that are importing things. My favorite thing is Amazon's headquarters right now. Have you guys seen what's going on? There's cities that are competing for this. And I think, there's some discounting of like how big this potential is. I mean, they're going to move, one of the biggest companies in the world to a place like Pittsburgh or Cleveland or Atlanta. These are cities that need a tremendous revitalization. And if they plop that thing down in the middle of this Rust Belt, it could change that landscape pretty drastically, I think, in a positive way. So I'm kind of excited to see what happens. My money's on Pittsburgh. I actually think, there's a really cheap housing there. There's a unutilized international airport that is right there next to the city. There's like 5 major universities, Carnegie Mellon, Pittsburgh, there's a ton, Duquesne University. So they kind of got everything there. It just depends on who dangles the biggest carrot for Amazon. And again, like we talked about in the summertime, there's some major technology, that's could revolutionize the world as we know it coming down the pipe. Driverless cars, blockchain. Anybody heard of blockchain and Bitcoin? Is it scary yet? Has 90% drawdowns. It's kind of fun. I own some just sort of to enjoy the experience of it, but I wouldn't recommend you guys really touching it. It's interesting. It's an interesting piece of technology that in theory could change banking pretty drastically. But right now it's the Wild West, man. It's you have no idea if you put money in that, if it's going to disappear tomorrow.
Like Bitcoin?
Yeah, Bitcoin. There's a bunch of different Bitcoins now. There's 200 of them. You have no idea which one's going to make it. It's really a crazy part of the industry. So any questions on that? Any questions on prior slides? That's sort of the meat of my presentation tonight, just to really give a summary of the important data going forward this year. Next meeting is going to definitely be about taxes. I know we've been me and John have been trying to gather a lot of information about, now it's changing so much. What are some different strategies that we're going to go over next meeting? But that's basically it for me tonight.